Greetings and thank you for joining me for a brief introduction to Yeske Buie's investment philosophy. We're going to start with a discussion of our worldview, our beliefs about the fundamental ways in which the world works. And then we're going to talk about the philosophy that arises from that worldview. And finally, we'll discuss the actual investment process we use to implement that philosophy with client portfolios. I want to start by talking about the economy. The economy is in the news every day. You can't escape it. You read about it in the paper, you hear about it on TV, and everything gets reported by numbers and statistics. We hear about gross domestic product and the GDP deflator and changes in the money supply and changes in the unemployment rate and interest rates. And it all at some point starts to feel or sound like a big machine of which we're just perhaps cogs. But the economy is actually something very different. The economy is you and your family and your friends and everyone you know and everyone else going about the daily business of earning, saving, spending, and investing. And all of those individual decisions aggregate up to this thing that we call the economy. Which brings me to the first proposition of our worldview. We believe that human beings are fundamentally growth-seeking, ingenious, and resilient. As a consequence of that, the U.S. and world economy, which is nothing more than the aggregation of those individual human beings' actions and decisions, must also be fundamentally resilient and biased towards growth. And the stock market, which is nothing more than a reflection of the real economy, it just represents the ownership of the productive assets of the real economy, it must also be biased towards growth over the long run. But let's talk more about those markets. We know in markets, they can be very scary, they can be very random. They are very hard to predict. And they're very hard to predict for the same reason the weather is. You know, meteorologists practice a real science, but they have trouble predicting the weather in the short run because they're dealing with a phenomenon that is so complex and chaotic. And in the same way, the economy and the markets are complex and chaotic. In any given year, there are 24 billion trades on the global stock market worth more than $100 trillion. That's a level of complexity that is frankly very much like the weather. But it doesn't mean there aren't deep regularities, just as there are deep regularities with the weather. For example, if you ask me to predict what the rainfall was going to be in my region for the next 12 months, I'm sure I wouldn't know. But my best starting point is probably to tell you what the long-run average rainfall is. Now, we know that in actual practice, in the next 12 months, the actual rainfall is going to be above the long-run average, or it's going to be below the long-run average. But with each passing year, the cumulative rainfall is going to begin to converge on that average. There is a deep regularity that can be recognized, and it could be harnessed. Regional water managers can size reservoirs in order to meet water consumption needs over the full cycle. All right, so much for deep regularities in the weather. What are the deep regularities in the markets? Well, first of all, one of the deep regularities is that stocks over the long run produce higher returns than bonds and similar investments. That small company stocks have higher returns than large company stocks. That stocks that trade at low prices relative to their earnings or their assets, we call those value stocks, that those produce higher returns than growth stocks, those trading at a high price relative to their earnings or their assets. I mean, let's look at the record. If you had invested $1 in small company stocks back in 1926, that $1 would have grown to over $26,000 today. Now, that same $1 invested in large company stocks would have grown to $5,000, only 1/5 as much. So here's an example of, over the long run, small company stocks producing 5 times the return as large company stocks. And you don't have to go all the way back to 1926 to see this, but it's particularly impressive over that time span. Now, bonds, an investment in a constant maturity 20-year treasury bond would have grown to $132. Even large company stocks produced a return 40 times greater than that. And then low-risk investments like T-bills would have grown to $21, not really doing much better than the keeping pace with inflation. The key is that these are deep regularities that manifest themselves over a longer period of time, over a period of years. So we also believe that stock markets do a good job of relating risk and return. And the reason for that, is because stock markets, just like the economy, they are human systems. It's a human system. And the current price of a stock, it represents the consensus of all the humans, all the investors that are in there buying and selling, showing up with their non-overlapping bits of information and voting with their dollars. And that there's an emergent wisdom from that collective activity, from that entire human system, that is difficult or impossible for even the smartest individual analysts to best. And so it really is, it's not a good proposition to spend the time and the money to try and outsmart the market. In general, you'll fail. In general, academic research has shown that the amount of money you spend to do superior research and earn superior returns is just about offsets the returns you earn. So the academic evidence says, on average, you're not going to expect to be able to beat the market. There's an emergent wisdom there, and you should just simply try and harness that emergent wisdom. So the investment philosophy that arises from those prior propositions include a commitment to trusting the wisdom of crowds, of understanding that markets do a good job of relating risk and return, and it's not going to pay us to try and to spend the money and the effort to try and outsmart the market. That the economy and the markets are so complex that they defy short-term prediction, and therefore what we need to do is try and identify those deep regularities that can be harnessed instead, that we can build a portfolio strategy around. And finally, that we need to manage risk through diversification and rebalancing. Diversification is one of the most powerful, and this is the single most powerful way to control investment risk. And rebalancing has been shown to not only control risk, but to actually add to returns. Okay, so how do we implement this in our actual process? Well, of course, we have to start by identifying those risk factors, those asset classes that we want to invest in. We've already talked about those. The market, stocks in general, small company stocks over large, low-priced or value stocks over growth stocks. But once we've identified those, we need to create a blueprint for the portfolio. We start with a blueprint. You know, we don't just assemble a portfolio one good idea at a time. We start with a blueprint that tells us what the whole is going to look like. And once we know what the final product is intended to look like, we have to choose and assemble these efficient building blocks. Now, we use institutional class mutual funds that give us very precise exposure to these market segments of interest, these risk factors of interest, and do so at extremely low cost, and they're also very tax efficient. And finally, we have systems in place to monitor and report and to systematically rebalance. Now, I want to say just a little bit more about value stocks and what it means and how we identify them. So if you look at everything a company owns, if you look at its office buildings, its manufacturing plants, its warehouses, you add to that any inventory they own, any cash in the bank or retained earnings, all of that stuff adds up to their book value. And if you take the number of shares outstanding and divide it through that book value, you can come up with a measure called book value per share. And that becomes a way of ranking stocks by expensive to cheap. So for example, in this scenario, we have two hypotheticals. ABC Inc., which has a book value of $3 per share and is trading at $6 per share. Well, if we divide 3 into 6, we come up with 2, a price to book ratio of 2. And we can compare that to XYZ Inc., which also has $3 per share of book value, but it's trading for $15 a share. And it has a price to book ratio, therefore, of 5. So it's trading at a price that's 2.5 times greater relative to its book value than ABC Inc. And ABC Inc., therefore, would be a value stock, and XYZ would be a growth stock. Now, how does a company come to have a low-priced a low stock price relative to its earnings or its assets? Well, let's start with looking at the notion of a stock price today having embedded in it implicitly a future stock price that's higher. Right? Any investor is going to buy a stock hoping it's going to go up in value. If you pay $20 for a share of stock today, you're hoping at some point in the future, 6 months from now, 12, 20 months from now, it's going to be worth $25 a share, $30 a share. And the difference between that expected future price and today's price is the implicit or expected rate of return. And there's some range of uncertainty around that because stuff can happen. And in this case, the range of uncertainty is my attempt to take a bell-shaped curve and turn it on its side. But things happen. Bad things can happen to companies and to industries. And when bad things happen, that range of uncertainty about the future outcome becomes greater. And in the face of that greater uncertainty, investors may decide that the implicit return in today's stock price is inadequate to compensate them for that greater uncertainty. And so what do? They do the only thing they can do. They push the price down. There's selling pressure, and through all of the buying and selling that's going on, the price eventually finds a new consensus at which investors collectively decide that at this price, the implicit rate of return is sufficient to compensate me for that greater degree of uncertainty. So there was some interesting research done around this mechanism by Lakonishok, Vishny, and Schliefer a few years ago. They took a database of stocks and they were able to year by year rank all the stocks in their database from those trading at a high price relative to its book value to a low price. I think there were about 5,000 stocks in that database, and they divided it into 10 equal number portfolios. So each of these 10 portfolios had about 500 stocks in it. And they did that year after year after year, so they had a whole bunch of these decile portfolios that they could study. And what they did is they measured the return of each of these over the next 5 years. And what they found is that what they called the glamour stocks, the growth stocks, they had the worst return. And the value stocks had the best return. And it was a perfect linear relationship. As you moved up to the next lowest one, it had the next highest return and so forth. Well, what they did next was particularly interesting. They then turned around and they looked at the performance of these portfolios for the 5 years preceding the time that they were formed. And what they found is during that 5-year period, the glamour stocks had the best returns. That's how they got to be high-priced stocks. And the value stocks had the worst returns. That's how they got to be value stocks. You can see that, of course, this is the mechanism whereby investors were pushing the stock price down because these companies or these industries were facing some new challenge. And it's important to note that the market does a good job in the aggregate. This whole strata of the market manifests higher returns. But there are individual stocks in there that don't. So this is a case of harnessing the aggregate goodness, but recognizing that you need to control risk by diversifying. You can't just cherry pick 5 value stocks from this group. You might pick the 5 wrong ones. They might not go up in value. You have to buy the entire strata in order to spread your risk and in order to harness that aggregate goodness. The other thing to note about being a value investor is that part of the reason that these companies as a group successfully produce those higher returns is because the individual human beings who work for these companies, they're resilient and they're ingenious, and they work the problem, whatever the problem is, and they solve it. So this is like the ingenuity zone. You're making a bet on human ingenuity when you're a value investor. And history has shown us that that's a good bet to make. Now let's talk about actually building the portfolio. So we start geographically neutral, which is to say we allocate to countries and regions in a way that's proportional to their share of the global stock market. We don't believe there's any systematic return associated with choosing one region or one country over another. So we start with this neutral allocation. The US market represents about half the value of the global stock market. So about half of our stock investment goes in the US. The other half outside the US, mostly to developed markets like the UK, the Eurozone, Japan, Australia. Some of it goes to emerging markets, and that's been a growing share of the portfolio. But we know we don't want to be neutral when it comes to small company stocks, because small company stocks represent a very small part of the market. Both in the US and around the world, small company stocks represent only about 10% of the value of the market. And we know we want to have a bigger allocation than that. So we're going to consciously dial up our exposure to small company stocks. And of course, the only way we can do that is by dialing down proportionally our exposure to large company stocks. And then we're going to want to tilt the whole thing towards the value stocks. Now, this is just a 3-dimensional representation that captures both the size allocation and the value allocation. And so you can see, for example, that small company stocks are aligned along this front row, and they obviously represent more than 10% of the portfolio because we've consciously dialed up our exposure to those stocks. And then we have tilted everything towards value stocks. We've bought more value stocks in each size category, and as a consequence, you have that distinctive skew towards value, or tilt, as we like to call it. So now let's bring it all together and talk about how we actually operationalize that. So we'll start with a broad market allocation to small company stocks, and then we'll add another building block that specifically tilts towards the small value stocks. And we repeat the process with non-US small company stocks, a broad foundation, and then a building block that tilts towards small value. And we repeat that with large. In the case of US large stocks, we'll typically use an institutional class S&P 500 index fund for this slice of the pie. And then we'll add one that tilts towards value. And likewise for non-US stocks. And then finally, we add a building block for emerging markets. This one includes both large and small company stocks, and it tilts towards value. And then finally, a building block that's devoted to global real estate. These are like real estate investment trusts or REITs. They're real estate companies that trade on the stock exchange, but real estate has some attractive characteristics in a diversified portfolio. Then we make it resilient. We've been talking about what I call the risky core of the portfolio, just the stock portion of the portfolio. We then add bonds. We add a high quality stable bond reserve in order to then add the resilience that we need in the portfolio. And the size of that bond allocation is going to vary based on the individual needs and life cycle. So someone who's young or someone who's not yet retired, they'll have a smaller allocation to bonds. Someone who's older, who's in retirement, will have a larger allocation to bonds. In the first instance, it becomes a reservoir for rebalancing into stocks during a cyclical downturn. And in the case of those who are retired, it becomes a bridge to support spending needs during one of those cyclical downturns. So it's very important to choose the right size bond allocation in order to provide the appropriate amount of resilience. Next, we have to think about having a disciplined approach to rebalancing, because each of these building blocks that we've been talking about, each of these asset classes, these distinctive market segments, they behave differently. They don't move in lockstep. And so there'll be some month or quarter or year in which one or more of them are doing really well and others are doing less well or even doing poorly. And as a consequence, periodically, some of them will rise in value and exceed their target, and some of them will fall in value, they'll fall below their target. And so as they cross certain thresholds, we have to step in and restore the balance. So if something rises beyond a specified threshold, we'll step in and sell it back to target. And we'll use those funds to buy some of the thing that's below its target, to top it up to target. Now, sort of, in the abstract, you could say, well, we're selling some of the thing that's become relatively expensive, and we're buying some of the thing that's become relatively cheap. So in the abstract, you could say, well, we're buying low and selling high. And we all know that that's how you make money. Now, the practical problem is that when you actually do that, you're selling some of the thing that's been making you happy recently, and you're buying some of the thing that's been making you sad recently. So you really have to have a very disciplined approach. But a lot of research has shown that this not only helps control risk, but it actually adds to the returns of the portfolio. So I would like to finish where I began, with the philosophical foundations of our approach. First of all, we believe that human beings are fundamentally growth-seeking, ingenious, and resilient. And therefore, the economy, which is the aggregation of all the actions of those resilient and growth-seeking human beings, is also going to be fundamentally resilient and oriented towards growth. And that the stock market, which is just a reflection of the real economy, will likewise share that same growth orientation. However, the economy and the markets are too complex and chaotic for short-term prediction. So instead, we need to identify and harness those deep regularities that we can count on over the long run. And finally, there's an emergent wisdom of crowds. Markets do a good job of relating risk and return, and we do well to trust those prices, to trust the market consensus, because that's just one more human system, and not to attempt to beat the market through superior research. It's very expensive, and research has shown it doesn't add value. So thank you very much for spending a few minutes with me. We really look forward to hearing from you, hearing your questions. You can find all of our contact information on our website, so feel free to call us, email us, and I look forward to hearing from you.